Welcome to today's Explainer. I'm so glad you're joining me because today we're doing something really cool and incredibly practical. We're going to totally decode complex banking jargon by building a financial machine from the absolute ground up. No dry textbooks here, just clear, simple mechanics.
But hey, before we start grabbing wrenches and assembling parts, what's our end game here? How do you actually measure a bank's true success? Is it having the tallest glass skyscraper downtown? Is it those massive raw profit numbers splashed across financial news? Nope, actually it's neither. Today we're building toward a very specific, undisputed metric of skill that cuts right through all that noise.
And to get us there without drowning in Wall Street math, we're going to use a metaphor we all get, the lemonade stand. This little stand is going to help us build our pure intuition first, right before we tackle those razor-sharp analyst definitions.
All right, let's look at gear number one in our banking machine, CASA. Because obviously before a bank can do literally anything, it needs to get its hands on some cash.
Okay, let's really dive into this. Think of your lemonade stand. CASA is basically your auntie putting her spare change in your cash box just to keep it safe, or your little brother letting you hold his allowance in exchange for a tiny piece of chocolate. They are friendly, incredibly cheap sources of money. The precise Wall Street version, CASA is the share of a bank's total deposits sitting in current and savings accounts. A high CASA, that means a super low cost of funds. It's literally the cheapest money a bank can possibly get, and it kicks off the whole operation.
So you've got this cheap money. What's next? You feed it into the actual engine of the business, the NIM, or net interest margin. This is the spread, the gap that the bank actually gets to keep.
What's amazing is how perfectly this logic scales up. Back at the stand, let's say you borrow 100 rupees to buy lemons. You pay 5 rupees in interest to borrow that cash, but you sell your lemonade for 120. You earn 20, pay the 5, and boom, you keep a 15 rupee margin. In the banking world, NIM is your net interest income, expressed as a percentage of your interest-earning assets. It's the single most watched profitability metric out there because it normalizes the spread. It means you can look at a giant like SBI and compare it fairly to a tiny small finance bank on an entirely level playing field.
But look, no machine runs flawlessly forever, right? Enter the friction in our system, SMA, or Special Mention Account. This is exactly what happens when the wheels start to wobble.
Imagine a kid from the neighborhood is late paying for his lemonade. He hasn't skipped town yet, but you're getting that bad, sinking feeling in your stomach. In the precise banking sense, an SMA is a loan showing early signs of stress. It's the bank's internal watch list predicting trouble well before it officially hits the bad loan books. A growing SMA pool, that's essentially your storm clouds gathering before a total downpour.
And this brilliantly illustrates how that storm rolls in. A good loan rarely goes bad overnight. It starts with a one-day wobble in that SMA category. Give it a few days and you'll see slippage into the bad pile. Hit 90 days, it's unpaid, it's officially a total loss.
So we need to clearly define that exact painful moment. Slippage, and NPA, the non-performing asset. This is exactly when the good kid turns into the dreaded Bunty who runs off with your lemonade.
Let's say Bunty takes his lemonade on credit and just completely vanishes. That unpaid lemonade, that's a bad loan. Slippage is the rate at which those loans turn bad. And the NPA is when the interest or principal has been overdue for 90 days. Analysts are absolutely obsessed with slippage because it gives you the trajectory, like how fast are new bad loans piling up right now. NPA just gives you the history lesson of the past.
Well, how do we survive the Bunties of the world? Simple. We build armor for our machine. We need provisions and a PCR, which stands for Provision Coverage Ratio.
Think of it like this. Every time you sell a cup on credit, you drop a few extra coins into a little side jar. When Bunty inevitably pulls his vanishing act, you don't panic or cry. You just reach right into that ready jar. Precisely speaking, provisions are funds set aside from profit to cover those expected loan losses. And PCR? That's the percentage of your gross NBAs already covered by that jar. A high PCR means super low risk to future earnings. Why? Because you saw the hit coming from a mile away, and you were ready for it.
But there's one final layer of safety here, and this one is strictly mandated by the grown-ups, the regulators. It's capital and CAR, the capital adequacy ratio. If you're running the stand, the grown-ups step in and say, hey, you have to put some of your own pocket money into this. That way, if massive losses completely drain your provision jar, they eat your money, not Auntie's. In finance speak, this is the bank's own equity held as a cushion to absorb losses under the Basel III framework. It's the ultimate shock absorber that keeps a bank standing upright without collapsing during a truly terrible economic week.
Moving to our main event, ROA,
the ultimate metric.
We've built the engine, we've bolted on the armor, and now we reach the climax of our build. It's the end of the year, and your mom asks the ultimate question. After everything, how many coins did you actually bring home? This question strips away all the noise. It doesn't care how massive your stand is or how much money you borrowed to set it up. It demands to see pure, unfiltered skill.
So this is absolutely crucial to grasp. We are talking about return on assets, or ROA.
If your entire stand is worth 100 rupees and you bring home 1 rupee and 50 paise, that's your ROA. And the beauty of it is, you cannot fake it just by being huge. A massive bloated stand squeezing out a measly 30 paise per 100 rupees is doing way worse than your tiny stand efficiently wringing out 150. The precise version, ROA is net profit as a percentage of total assets. It is literally the cleanest measure of balance sheet efficiency out there because it's leverage neutral. Size and borrowed money simply cannot flatter it.
And here is the magic number you need to burn into your brain: 1.5%. When you're evaluating a bank's return on assets, 1.5% is the boss metric. It explicitly strips out the illusions of size and leverage to reveal the bank's true underlying operating skill.
To put that into perspective, let's look at this practical little scorecard. If a bank's ROA is over 1.5%, you're looking at excellence. Honestly, top private banks push around 2.4%. Anything above 1.0% is solid, good performance. But if that number slips below 0.8%, things are getting wobbly. In really rough economic cycles, those troughs can dip all the way down to 0.28%. Next time you're staring at an earnings report, keep this scorecard handy. It's basically an instant lie detector for performance.
Okay, let's take a breath and look at this whole beautiful machine working together. A bank gathers money cheaply, that's our CASA. It maintains its spread, that's NIM. It constantly watches out for wobbles, SMA and NPA. It keeps a coin jar ready for a rainy day, provisions. And finally, it lets ROA, return on assets, reveal the absolute truth about how well the whole thing is actually running.
Which brings me to a final thought I want to leave you with. If return on assets proves that sheer size doesn't equal actual skill, what hidden risks might be lurking inside the biggest banks in your own portfolio? Don't get blinded by raw profit numbers or massive loan books anymore. Look under the hood at the machine, look past the size, and use ROA to find the real efficiency. Thanks so much for joining me for this explainer. I hope you feel empowered to read those balance sheets with totally new clarity. Keep digging into those numbers, and I'll see you next time.